The Wall Street Journal this morning reported that Tesla announced another round of price cuts. Tesla dropped the base price of Model S about 5% and dropped the base price of Model X about 9%. Now, this comes on top of price cuts that Tesla announced in January, where it lowered the price of its baseline Model Y by 20% and the high performance Model 3 sedan by 14%. Now, this was on top of price cuts it announced in December in China for certain models of double digit price decreases. So, what does this mean for investors? I'm going to go over that in this video and we'll talk about how that's going to impact Tesla's gross profit margins and then how it could impact its valuations. So, stay tuned and let's get right into it. Tesla's gross profit margins is the highest in the EV industry. If we look at here, what I have pulled up is a chart of Tesla's gross profit margin over the last 10 years. And of course, to calculate the gross profit margin, you take sales minus cost of goods sold, and that gives you gross profit, and you divide gross profit by sales, and that gives you the gross profit margin. It essentially measures how much profit Tesla makes from the sale of each car, right? How much does it cost to produce the car? And how much it sells it for, and then what's left over, that's the gross profit. And that's before accounting for things like general and administrative expenses and rent and insurance and employees and many other costs like that. That comes further down along the income statement. This just tries to capture the profit from each car sale. And it's important because this is the money that's left over to spend on those other categories, right? And at 25.6, Tesla is way, way ahead of all other EV companies. I think the next closest might be Neo at 10%, and the rest, many of them are negative. You know, Rivian, Lucid, um, several others. I think Polestar just turned positive in the gross profit metric, making really good progress. But many of them are negative and way below Tesla. Polestar, I think, just reached 6.9% gross profit margin. Again, way behind Tesla here. But what happens here is when you see a price cut, that will impact gross profit margin, right? Because that's lowering the sales price. Meanwhile, the cost of goods sold does not decrease when you decrease the sales price, right? That stays the same. That doesn't change. So you have a smaller sales price and cost of goods sold that's staying still, and so that leaves you with a smaller margin. So that's going to impact Tesla's gross profit margin. Certainly, it's going to impact that. Now, Tesla will hope to make that up by selling more cars. So even though your profit margin is lower, your total gross profit could be higher if the lower price fuels higher sales. Okay? But that it needs to have enough sales to offset the decrease in the margin. What does that mean? So let's say you're selling 100 cars let's say you're selling a car for $100 at a 25% gross profit margin. That's leaving you $25 in gross profit per car. If you lower that gross profit margin to, let's say, $12.5, now you need to sell two cars at that lower profit margin to make up for the loss in margin, right? So you got to make more sales to counter that. Now, it's uncertain how much Tesla's gross profit margin is going to decline as a result of these price cuts. In their most recent conference call, management hinted at the possibility of the gross profit margin falling into the teens. So, 19%, 18%, 15%. Um, they did allude to the possibility that it could fall into the teens. Now, another thing to consider if you're thinking, oh yeah, but when Tesla cuts its price, it's going to just boost sales, right? That's not so sure, right? Don't be so sure of that because Tesla doesn't operate in a vacuum. It's not the only EV car company. And when Tesla announces a move like it just did with the price cuts, the other car companies notice. The other car companies notice. And if you recall, in January and December, when it announced its first price cuts, Ford, Rivian, and others announced that they would be cutting their prices as well. They would be cutting their prices too. So when Tesla cuts its price, the other car companies notice and say, hey, Tesla's trying to get more sales and they're trying to take those sales away from us. We're not going to let that happen. We're going to lower our price too. And then Tesla now is announcing another round of cuts, and now um, the other car companies are going to notice. They might announce more cost cuts too, price cuts too. And so what this is doing is just bringing down the profitability of the entire industry. The entire industry is going to go through lower margins as a result of these price cuts, as a result of this increasing competition. So overall, I suspect industry profit margins will decline throughout 2023 because at the same time this price cutting competition is happening, there's inflation is causing the cost of goods sold to increase as well. So they're getting hit from both sides. Not good news. And this is what I've been talking about and why I'm not bullish on the EV industry. I'm actually bearish on the EV industry, even though I fully expect the number of sales to grow. I fully expect sales to grow, but I think those sales are going to come at smaller and smaller and smaller margins as the competition becomes fiercer and fiercer and fiercer. So there's going to be a lot of sales, there's going to be a lot of growth, but profits are going to be harder to come by. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Let me show you another chart here. So this is Tesla's valuation. It's trading at a forward price to earnings ratio of 48.87, a trailing 12-month price to earnings ratio of 53.77. So the stock is already expensive. A forward PE ratio of 49, let's say, that's expensive. Um, that means if earnings do not grow at all, it could take 49 years for the company to earn the to return to you the price that you paid for the stock, right? So you're paying 49 times next year's earnings, right? So that means it's going to take 49 times that level of earnings to get to make you whole for the price you paid. So that means if earnings don't grow, you're paying 49 years worth of next year's earnings to buy the stock. Now, of course, investors in Tesla fully expect earnings to grow over time, and that's why they're willing to pay a higher price multiple because earnings are expected to grow over the years. But if gross profit margins are declining and competition is increasing, how much are earnings going to grow? That's becoming the big question. And I want to show you this other chart here. So this is the gross profit margin for a number of Tesla's competitors in the overall car space. Right now, I'm not just comparing Tesla to EVs, I'm comparing Teslas to regular car companies, right? Ford, Toyota, GM, Ferrari, Mercedes, Nissan, right? And what you notice is that there's only one car company that's able to generate higher than, and I'm looking at numbers before 2019. Okay, I'm looking at numbers up to 2019 because that's when the car market was disrupted, and I'll explain how in just a moment. Before 2019, Ferrari was the only one generating gross profit margins above 20%. Okay, so at 2019, Ferrari was the only one generating gross profit margins above 20%. It was at 52.5, and this is a unique car company, luxury sports cars, very high prices, very limited quantities, not at scale, right? So it's unrealistic to think Tesla could achieve anything near that, right? It's more likely a better comparison to do Tesla with all the other car companies, right? And everyone else is in the teens, right? Gross profit margin in the teens, 19% for Mercedes. Tesla was at 18, Toyota at 18, Nissan at 17, Ford at 15, and GM at 9.59. So it's more realistic to think that Tesla will end up somewhere here in the longer term in terms of their gross profit margin. So gross profit margin very likely to come down and settle around this level because remember in because of the pandemic, the supply chain shortages disrupted the car industry, and car companies have been able to sell their cars at higher prices because of limited quantities, and they've also been able to reduce manufacturing of the lower margin cars and produce more of the higher margin cars. For instance, think of Honda, let's say, instead of making the Honda Accord LX, which is the basic model, they focus on making Honda Accord EXL, which is the higher margin, higher priced model that comes with leather and navigation and all these features that they're able to charge higher premiums for. So, because they're in such high demand, customers have been saying, okay, you know what, we'll just buy it because there's nothing else available. That's not sustainable longer term, right? That's not sustainable longer term. Just a brief blip in car sales due to the pandemic. So, overall, if you look at Tesla's valuations trading at a forward PE of 48.89 and really tempered their expectations on where they think Tesla's earnings will go, because they may increase the amount of quantity sold, but those numbers are going to come at lower margins as competition is going to continue ramping up. They're all going to start to want to take a piece of the market share, and there's only a limited amount of consumer demand for EVs. And all these companies are now ramping up production. So temper those expectations. Pay attention to the valuation. Don't just be willing to pay ridiculous valuations for Tesla stock just because you think it's going to grow and you think it's somehow special, and it's not exposed to industry competitive forces like every other car company is. Okay, so that's all I've got for this video. As always, thank you for watching. And if you enjoyed this video, I'm going to link you to a couple of more videos at the end of this one that I think you will enjoy. So please click on one of those, and I will see you over there.